Welcome to the Capital Idea, financing alternatives for liquidity events. This session is presented by Lock Lord and Prairie Capital Advisors. Let's meet the panel. First, meet Lou Kentner, founding principal of Prospect Partners. Next, please welcome Terry Bressler, managing director of Prairie Capital and Partners. Michael Wilson, partner, Lock Lord. And moderating today's session is Steve Ryan, director, Prairie Capital Advisors. Terry, the floor is yours.
Hi, my name is Steve Ryan, a director of Prairie Capital Advisors, an ownership transition firm that specializes in ESOPs as well as valuation. We're here today to talk about Capital Idea, financing alternatives through liquidity events. I'm joined with three panelists, esteemed panelists, and I'll have them introduce themselves after I do the introduction here. We appreciate Smart Business giving us an opportunity to highlight our skills. The goal here is to talk about the philosophy of what it can lead to different paths for owners as they transition their businesses. Each business owner considers their options. It's a more psychological and emotional path than it is economic for them. I'd like to introduce my panelists who are joining me. Lou Kentner, the founder of Prospect Partners, Mike Wilson from Lock Lord, and Terry Bressler from Prairie Capital. Lou, why don't you introduce yourselves a little bit?
Thank you, Steve. I've been in the private equity business for about 30 years now. Started Prospect Partners about 25 years ago. We invest in primarily lower middle market companies in the $2 to $7 to $8 million of EBITDA kind of range, so smaller companies. Been doing it a long time. We've done over 100 investments in that field, and we're an industry generalist. So we work all over the country, lots of different industries and lots of different types of transactions.
And Mike?
Thanks, Steve. My name is Mike Wilson. I'm a partner at Lock Lord. I have a hybrid practice. I do mergers and acquisitions, venture capital, debt finance, and fund formation. Spend most of my day working with either the investor side, so PE funds, VC funds, family offices, or the entrepreneur side. I've spent a lot of time working with companies, helping them through the process that we're going to talk about today. What are some of your inflection points? When is it time to sell? When is it time to take a new investor? Work a lot with small businesses. That's been a big part of my practice, including SBIC funds. Also have a niche in PPP loans, which we won't get into because I still have the after effects of the whole PPP process, but very focused on small businesses, and so happy to be here today.
And Terry.
Good morning or good afternoon, everybody. I'm Terry Bressler. I've been in the M&A business for about 35 years, focused mainly on sell-side deals, helping companies sell the business. And predominantly working with families and owner-operated businesses like that. I've also done a wide variety of recapitalizations and attracting capital for different purposes, and we'll get into some of the details of that momentarily.
And again, I'll reiterate, our goal is to highlight the psychology of what business owners do as they are looking at alternative paths. Each of the panelists here does not probably have a degree in psychology, but I bet they've been through enough deals that they could probably teach an upper level education class at any of the respected universities within the country. The plan here now is to go through kind of three different paths that a business owner may have. And each of the panelists will talk about the seller's intentions, whether it be a full exit strategy for full liquidity. Lou will lead that initiative. The second will be a majority transaction where Mike will go ahead and walk through kind of that path. And then Terry will then look at the alternatives on a minority, saying, what are the other alternatives as it pertains to those, and the things that business owners need to think about as they're going through those alternatives. With that, I'll lead it with Lou. How do you help and know when a client's ready to go?
Well, typically we see the end result. So we're the first team to see that family business that's going on in the market. So we see to some extent the good, the bad, and the ugly. I think the most important thing I would say is for companies, especially if they've not been what I'd call professionally owned by a PE firm or by some other institution, most of the companies we see are family businesses coming to the market. And I think my biggest comment, number one thing they could do is be totally ready to do this. And that falls on a lot of different lines of questions. You can't just decide to kind of enter the market because, hey, it's a good time to sell because Biden may change the tax law this month. Let's kind of run the market. You should have been thinking about this, years in advance. There's so many things that need to be prepared before you show up. Typically, most of our sellers have never sold a business before. So it's the first time they're showing up, and we're kind of leading them through the process. Most entrepreneurs sell a business once, maybe twice, but that's kind of it. They're not experts in selling and going through this process. So it's a complicated process. I think the first thing I would say is be ready to address issues in your own business. And that means looking at your management team. Are they totally ready? Is everyone else on board with what your plans are to go exit this business? Have you told the rest of your management team, hey, I'm leaving, I'm going to sell the company, and you guys are going to march on? Many times the owners, just because of the way they've run the business, they tend to keep the information flow to themselves. And there's no right or wrong way to do that. But at some point, the rest of the people have to know, at least your senior management team, have to know what you're planning. And are there any other issues that you need to plan for in advance before you even engage in a banker to go forward? Stuff like, hey, we've had one good year in a row after 5 years of losses. That's always a tough, you hand that over to Terry and say, Terry, go sell this. And Terry's going, well, what's been going on for the last 5 years? So you need to have the perspective of the buyer when you're thinking about trying to sell. And that means looking at your own history, financial history. Is your management team ready? Are there any weird things going on in the market? Is something going on in the marketplace that's obvious everyone will know? Is something going on with your major customers? Just kind of an overall review of what's ready, and make sure you can answer those questions. Is your company ready for a deep dive by an outsider to look at all the details of your financials? A lot of people, I was just talking to a seller yesterday that's not represented by an investment banker, and he kind of threw out some flippant comment. Oh, well, it's an add back of $700,000 because me and my brother don't take any. We've taken $700,000 of salary out of the company, and then he went back and clarified. Oh, this year it's only been $300,000. Okay, so it doesn't give you a lot of confidence he is ready for this process, and that he knows what his own numbers look like. I think the second thing is to understand that you haven't done this before. It's not a sign of your lack of business acumen or whatever. It's just there are advisors out there that can help you through this process. And I think it's probably starts with your investment banker, who your partner is, who's going to help you understand what is realistic to exit. If I'm going to sell this business, what can I expect? That is a really complicated question, and it's not straightforward, and it's not something that everyone is obvious to understand. There's a lot of country club talk. Hey, I sold my company for 10 times EBITDA, or hey, companies like this are selling for 20 times EBITDA. Just look at what Facebook's trading for today. You have to get a realistic point of view from someone from the outside that doesn't have the baggage of maybe you're 30 years in that business, who's saying, hey, companies like this trade for X. And it's good to get maybe more than one opinion. The advisors are there to be used. So I think number one is find yourself an advisor that you like and trust, do reference checking, figure out who that person is going to be, and then listen to him. Because he's probably going to have a lot of advice that maybe sometimes is tough to hear. Like, hey, you and your wife are great running the company, but the number 3 guy really needs to know what the monthly financials look like so he can answer some questions. And it's not just your investment banker. There's oftentimes I see in the small family businesses, especially today, they've gotten no tax advice. There's no one telling them, hey, this is what we're trying to sell. So part of understanding when you go into the marketplace is you have to know what you're selling. Are you selling the stock of your enterprise? Are you selling the assets of your enterprise? Are you indifferent to those two? The answer is you never are. And what state are these assets going to transfer in? All the issues that Mike would say, well, you have to understand what you really are trying to get out of this thing at the end of the day. So you need to have a tax advisor. A thing that's very prominent today, as Terry will tell you, is rep and warranty insurance is often used to in the price of a sale when you're going to sell the company and walk away. That rep and warranty insurance is really important. That protects you against all the reps you've made to that buyer over time and you have insurance to protect the buyer and you, that someone's going to pay if an unknown liability shows up, there's no way you have experience in that. That's something that's probably worthwhile exploring early on, figuring out who is going to underwrite it, what terms you might want to get, or even if you're going to entertain it. If your business is too small, you probably can't get rep and warranty insurance. Then you're going to have to rely on escrows. And you want to have a conversation with Mike, determine, okay, what's realistic and what can go in that bucket and what not. And this is way before you've ever talked to a potential buyer. You have to understand and run through your own mind how this is going to work. So trusting your advisors, certainly an investment banker, a lawyer who, on the contract side, on the tax side, and on the insurance side, is just kind of a minimum price of poker. And then through that process, with your advisors, you develop a game plan. What's the game plan? And it could be, I'm going to talk to 5 guys in my industry that I know have tried to buy me over the last 5 years, and they're all waiting for this phone call. At least that's what you think. That may be totally right. It also may be that Terry says, hey, there are hundreds of private equity firms that would love to buy your company because of what it is and where it is in the marketplace. We ought to go to a broad market test of lots of different players to figure out who we should show this to. Those are 2 totally different processes you're going to approach: a fireside chat, so to speak, with a few buyers, and a blast email to 500 of your closest friends across the country who might buy the company. Again, there's no right answer. One may be right for one situation, one may be right for the other one, and develop an understanding of what that process is. Another thing you and your advisor will do in that process is figure out who you don't want to show it to. There may be companies, for whatever reason, you're a key supplier to somebody else. You don't necessarily want to show the book to that particular buyer. You don't want to show that buyer to a potential competitor because you're not comfortable with what he's going to learn, and you don't think he's a serious buyer of the business. So being thoughtful about who you don't want to show it to is just as important about who you do want to show it to, and then relying on your banker to protect the process.
Now, Lou, the difference from an owner perspective, selling total liquidity versus partial, is there much of a difference? Or when you're setting back as an owner saying, I'm going to go and I'm just going to totally walk away. So somebody really has to get comfortable with what they're doing next.
I don't think, as a buyer, and I've been in both those situations, if it's an individual who's running the business, I don't think there's a lot of difference, because you are going to have to be on the hook for lots of things in the contract that Mike is going to draft, and lots of issues because you are the knowledge keeper. There are situations where bigger companies are selling an asset they really aren't that close to, a corporate orphan, if you will. Those kind of situations, I would say it's a little bit different sale, because that corporate officer may not be as aware of that particular enterprise because management is going with it. That's a very different sale. But if you've been the owner and the operator of that company, I think the things you're going to have to know are basically the same in terms of what you're going to do when you exit.
But
I'm sorry, go ahead.
From a psychology perspective, the old, what am I going to do the very next day after I sell my business? That's the most difficult thing, I think, for business owners to.
The question I love to ask people is, okay, you're going to sell the business and you're going to get $20 million. What do you do with the $20 million? Usually I get a totally blank stare, because they have no idea. They haven't thought about what they're going to do with the money. And that's not unusual. They just don't know. They have a number in their head that they've had there maybe for a bunch of years, and that's kind of what they're trying to get at. But understanding what you're going to do could drive you to one scenario or another. You could say, hey, I do want a place to go for the next 2 years, because my wife married me for better or for worse, but not for lunch. So I do need a place to show up for the next 5 years, or my wife's going to kill me. Sorry to be sexist. Maybe it's the other way around. Maybe the wife needs a place to go, so the husband won't be upset. So I do think that's part of it. If you think you want to be close to the business, even though you're, quote, selling and walking away, it's kind of a self-reflection. Are you sure you want to walk away? Because most of these companies, it's their baby. And it's very hard to just say, hey, I'm off and running. and don't really care what happens. That's just not realistic.
I think that's a good segue into Mike, talking about the majority ownership transition to where the owner is going to still maintain a majority of it. Mike, give us a little bit about your thoughts on that, and talk to us in particular about rollover equity, earnouts, and how you structure those types of things.
Yeah, well, the first comment I was going to make was to one of your prior questions, Steve, which I thought was a great point, is that the process in terms of majority deal, minority deal, total sale doesn't really change in terms of what you have to be ready for. To Lou's point, you've got to be fully ready to do all of those things. When we think about from a legal perspective, that means the due diligence process is pretty much the same. Your company should be ready from a diligence perspective to open the kimono. I think first-time sellers are always shocked at the breadth and depth of the due diligence process, and why do I have to provide every single contract, and why do I have to provide this litigation that happened 4 years ago? They're always surprised by that, and I think it's important to get with your advisors early, as Lou said, to work through those things. When you enter a process, if you can show a buyer or an investor that you're ready and everything's clean, and you sort of prepare the canned answer to why you had this litigation 4 years ago, that buyer is going to get a lot more comfortable a lot quicker, and it's going to be an easier and smoother process. I think some of the most challenging deals are where the entrepreneur or whoever's on the sell side says, yeah, we have these issues, but they're not a big deal, without really justifying why they're not a big deal. And then you're scaring your buyer. Your buyer's you're going to lose trust in you, and they're going to dig even deeper in the diligence. So being ready is so paramount. In terms of selling a majority of your company, but not the whole thing, the psychology behind it's really interesting. There's a couple different ways that type of deal comes about. I think the most obvious is when you are part of management and the buyer insists that you carry a significant amount of rollover equity into the post-closing deal. That helps them, keep you honest, because if you're making reps to them, they know you're going to be truthful because you're invested going forward. So sometimes it could be buyer driven, but I think when the seller's thinking about whether they want to keep some stake in the business, it comes down to a couple things. Do you believe that this business still has a lot of upside to go? Do you believe maybe you're selling a little bit earlier than you could have to maximize your value? I think if you're thinking along those lines, oftentimes an entrepreneur or seller is going to want a second bite at the apple to go alongside a majority owner. The other way is you don't think the purchase price is high enough. You're selling for something that you think is too low, but you can't get the buyer to move. A rollover equity or sometimes an earnout is just a nice way to juice proceeds, or at least have the opportunity to juice proceeds without increasing that top line number that the buyer is not going to move on. I think there's sort of the earnout conversation is interesting because earnouts are really a total sale type deal concept, where you're getting a second bite at the apple contractually over a short period of time, whereas rollover equity, where you're staying invested in the business but not controlling the business, that's longer duration, potentially higher upside, but has a little bit more risk because you are sort of waiting for that new buyer to sell. I think part of the analysis comes down to who your partner is. This new investor that's buying a majority of your business, who are they? How much do you trust them? Are they a PE buyer? So that they have a duration when they're going to sell. They're going to try to sell within 5-ish years. Or is it a strategic? Is it a company that you're joining forces with who you think can take this business to the next level, but they're strategic, so they're going to hold, and you may not see liquidity on your rollover equity for a very long time. A lot of different components that go into it. When we have somebody who's thinking about their inflection point of, am I going to sell the business or am I going to hold the business and find an investor and keep growing it? I think a lot of it comes down to the conversation we were just having. What is your long-term goal? Are you trying to stay in this business for a long time? Are you not ready to go take your proceeds to Vegas and have some fun? Are you really still ready to grind? And if you are, then staying heavily invested in the business is probably it can be a very good idea for you. I'd be curious, Steve and Terry, when you're counseling sellers, how do you get to significant rollover check? What do you counsel them through?
I would say, in fact, we just had it on a deal that just closed an hour ago this morning. And basically, the issue there was, I think, Mike, as you pointed out, the company was not quite ready for prime time, as Lou suggested. And there was still a desire for a liquidity event. It was a family business. And so we've got what I view to be a very good valuation, but it wasn't, the nirvana they were looking at. So the rollover equity was kind of the upside, the second bite of an apple. I think everybody uses that characterization. And so that's how we convinced the family, that we should do the transaction, when we did.
And Mike, what we try to do, we try to spend as much time up front understanding the goals and objectives of the seller. We as a firm, we have full M&A capabilities with Terry and his group and Tim Witt. We also do ESOPs. We do a lot of ESOPs that it's a right alternative for some people, but spending a lot of time up front talking to business owners about what it is they want to accomplish, how they want to accomplish it, how prepared are they for that, for lifting up the kimono, so to speak. In many cases, that's where we spend a majority of our time, and we just realize that if you're not prepared to sell your business for the right reasons, tax is the wrong reason to try to time it. It's like time in the market. There's no good way of doing it because it's more of a psychological and emotional decision than it is a financial decision in many cases. Identifying how important is liquidity, how quickly do you want to do the transition? With that, so Terry, I want to get to you and talking about kind of exit alternatives for minority transactions or other ways to extract value out of the business without fully. Well, I guess you probably still have to fully lift up the kimono, but without totally walking away.
Right, and it goes back to what Lou and Mike and Steve, you said, is basically you got to really understand the goals and objectives of the owners, and if their ideal is to get, or their idea is to get the highest valuation, right now, obviously that's a sale, and Lou went through the preparation for that as well. And at that point you're maximizing cash proceeds. You're probably going to a strategic who gets synergies, gets all of that. But there are a lot of other answers if basically, you look at your business and maybe you've got a partner, and so you're looking for a way to redeem that partner's equity ownership in the business. Or you like your business, maybe you're in your 50s, but you still need a measure of liquidity so you can go buy a house down in Naples and be Lou's neighbor. And so a way to take some money out of the company, without undermining the company. And then what we see this sometimes is, it's just not an optimal time to sell the company, but there are still desired liquidity needs by the owners. And, maybe to put a, fact pattern around that, say it's a business area right now where, because of the transportation and logistics issues, it's just not a good time to sell, but you still want to take some money out. And so recaps can kind of help you with those. And, again, there could be a lot of other personal things, and going back to understanding what the objectives are of the company owners, like improving their personal balance sheet, taking some money out to pay off some other loans. Maybe there's a desire to continue to develop the management team, but still, again, get some liquidity as well. And then, just as Mike was pointing out, there's just so many different companies where there's a needed capital for the owners, but the company itself has got some pretty good growth objectives or growth path, and you don't want to lose some of that. And so a recap could help with that as well. The one thing I'd say about recapitalizations as opposed to a sale, where essentially you are shifting the risk of the company to somebody else. In a recap, you're really retaining the risk of the company and the business. And so you got to look at two risk profiles in a recap. Number one, what is the company's business risk? And so, just be careful to understand, what the issues are in the marketplace, where you sit in the pecking order of competitors, et cetera. And then also consider the financing risk that you're going to put the company under, because a lot of these recap transactions might use debt. They could use senior debt from a bank, or there are specialty funds called mezzanine funds, which have a debt security as well as some kind of upside, whether it's a contractual, like a PIK, payment in kind, interest, surcharge interest, and then sometimes warrants. And so the combination of the business risk as well as the financing risk you're going to put it under has to be in some reasonable level, at some reasonable level. Otherwise you put the whole company at risk. And I would say,
in many cases, Terry, you're really increasing the risk profile because you're adding leverage to an asset that you're already accepting the risk. So you got to feel real comfortable that your business can withstand the additional financial leverage, which will place pressure on management, pressure on execution.
Exactly. And that's the other thing too, is keep in mind, there's this idea, there's a productive debt, i.e. you're borrowing money so that you can grow the business. And then even though it's kind of a negative sounding word, but it's non-productive debt, which is basically borrowing money to take it out of the company. And so obviously if you're ruining spending some of your borrowing capacity to take money out, that does change the risk profile of the business, maybe limits its growth opportunities. And so when you do a recap, as opposed to what Luz and Mike have described, they're talking about preparing the company totally for sale, getting all the books and records in order, having a firm understanding of what you can get. I would say that's all very important in any financing transaction as well. But then the other thing is you got to introduce the concepts of borrowing capacity, looking at the growth objectives and how you might limit the company's ability to grow and to change. And then also look at dilution as well. Because when you sell 100%, you're selling 100% diluted. But in a transaction I'm describing, you want to minimize the amount of equity, in quote marks, you have to give up. And then there's certain trade-offs. If you use mezzanine capital, obviously there's an interest rate component. And so you're trading a current pay obligation, which stresses cash flow. But in return, you're getting a lower dilution on the equity side, so less equity give up. And so there's just a lot of different variables in a recap. But I'd emphasize that, pretty much everything that we've described on a total or partial, sale, minority or majority sale, it's all the same. The blocking and tackling is the same on a recap transaction.
So let's pivot. Does anybody else have anything else to kind of highlight into that before I ask a question of you?
The only thing I would add is that the reason we asked what people would do with the $20 million is that suddenly they realize they will be an investor as opposed to an owner. And sometimes when Terry is talking about, well, would you be better off reinvesting $5 million to this company that better than anyone else on the planet? Is that better than turning around and giving the $5 million to Joe Blow from Goldman, who's going to manage your money? And what are his expected returns versus the expected returns you're going to get by reinvesting in your own business? And we encourage them to think like an investor because that's what we are. So the more they think like, hey, I will be an investor after this sale, that may lead them to be, hey, I'm more open to a recap because I can't figure out what the best alternative is for my money. And that's certainly been true the last 10 years because a lot of people say, hey, I'll put my money in mutual funds or in treasury bills or in municipal bonds until they figure out what the yield is on that stuff. And then they say, well, maybe I won't. Maybe I'll put it back into my company and move forward.
Yeah. One other thing too, Lou, in it, what you said struck me a little bit. And so recap transactions are not atypical for private equity owned businesses where the private equity fund has developed a management team and they want to see the management team succeed. And so if you think about it, that management team maybe through stock options and things like that, maybe own 10-15% of the company. A recap transaction could take Lou's fund out and basically through mezzanine, senior debt, maybe a measure of outside equity, but maybe not, kind of get the management team in a position to start creeping, their ownership up in a business as well. And so, again, these recap transactions, basically, I mean, it's been a hot M&A market. And frankly, It's huge right now. The M&A market's, one of the greatest bull markets ever. But there's still opportunities for mezzanine capital and recaps to play a role in family and other owner-operated businesses.
And as you think about what to do with that 20 million, we talk a lot about the due diligence on the sell side for the company. Don't forget to do your reverse due diligence on your buyer, your investor, your debt provider. Understand who they are, what their strategy is, what their timeline is. If you know somebody who has worked with them before, understand what kind of manager of a business they are, how good they are to work with, because oftentimes that will illuminate what you should do with that 20 million. I think a really good partner is what you're probably looking for if you're going to consider keeping money in the business. And that is just pure relationship building as well. So don't forget to do that reverse due diligence piece of it and really dedicate spending time with people, because they're not just writing checks. They're going to be your partner going forward.
Right.
So we got about 10 minutes left. So I got a question. So talk to me about the importance of not getting too emotional, right? And I don't know if you want to give me a live example, but and going back to the seller on identifying and maintaining his goal and his focus of those goals. Who wants to go first?
Let me just expand on what Lou said, and then maybe Lou can jump on it too. I mean, I think, Lou, what you said is you got to think like a buyer. And I would say even in recaps, think like an investor. What are they going to look at? And really, when you think about it, a business owner, it's their baby. They've done everything with the business. And I think and it's hard to do because that person has to step out and then look as to what their business looks like as somebody from the outside would look at it. And that's where I think a good attorney, a good M&A or an investment banking advisor, good wealth managers will help the business owner do that. Because again, if you get somebody else involved who just, you can say, look, you've done it this way for so long, you think that's the only way to do it. Stop thinking like that. How could you improve the business? And so I think, just through advisors is how you try to get the business owner to think outside the emotions, I guess, of starting the business and growing the business.
The other thing advisors can do in the deal process itself is there's going to be a lot of emotion just in terms of pushback and push and pull, and you're negotiating, so you're going to have disagreements. Lean on your advisors sometimes to deliver the tougher messages. The investment bankers are great at that when it comes to specific high level economic deal terms. The attorneys will do it on the deal docs, which we have to be the bad guy sometimes. It goes with the territory. Especially if you're going to stay in the business as an entrepreneur, as a seller, you want that relationship to be strong and positive and not bogged down with, we negotiated this materiality qualifier for 10 days. I'm so mad about it. Let the attorneys do that. Part of that, again, is identifying those people earlier and then building trust with them, because you want to be able to trust them to deliver that message in a way that's not going to blow up the deal. But let us be the bad guys. That's okay.
Yeah. And most sellers are not like Lou, because Lou is a professional buyer as well as a professional seller. And as I stated earlier, we predominantly deal with families. And so it's probably the once in a lifetime situation that they're ever going to sell their business. And so my advice is never go it alone. I mean, I am astonished at the number of families that think, oh yeah, I'm just going to go to my competitor and sell my company. I don't need an advisor. And to me, that's a recipe for disaster. The other thing too, and I think Lou mentioned this, is, one of the signals you should take from the private equity funds is that they rarely will go on a one-off deal. I mean, that occasionally occurs, but an auction is a wonderful process, whether it is a 5-person auction or a 50-person auction. But it breeds competition, and competition, I think, teases out better deals. And that's not to, make Lou discouraged when he sees a deal from Terry. Obviously, we're going to put him through the traps, and we know exactly what Lou is and his fund, and they're very good investors. But, you got to get a gut check. You got to get a second answer, if you will. Just like if you have major surgery, you're not going to just take one doctor's opinion on it. And so again, I'm astonished, again, the number of people that think, oh yeah, well, I'm going to hire an advisor. So that's a good first step. Oh, but by the way, I want to sell to this guy. And you can do that. That can be your goal, but let's set up a little bit of a mini process to make sure this guy is the right guy or gal, to be non-sexist, I suppose.
No, I think that's right. I think I think your point, Steve, is that I've never met an entrepreneur who's not passionate about his business, and therefore, when he's questioned about, or he or she is questioned about one issue or another, they've lived with those risks for a long time. So for them, that risk is kind of part of the business, and they kind of just, don't worry about it. I think your best advice is, I think what Mike and Terry were saying is, let your advisors carry the water for you on detensifying those situations where it's pretty tense with the buyer and the seller. You should rely on your advisors to break that log jam, and listen to your advisors. It's because sometimes the buyer may be right, and other times your whole team is saying they're full of crap, we should not do this, as Mike knows. So I think the issue is sometimes the buyers can ask for something unreasonable, and that's fine. And you can get upset about that, but let your advisors get upset about that. You shouldn't be the one returning that phone call.
Good. Yeah. Well, that's a good point. I never let the principal, I always try to intervene, never let the principal talk to the buyer directly on any issue, because emotion is going to get into it. And the thing is at some point, maybe you need them to be the hammer, when it's the final decision. But I always like to tell my clients that basically let me take all the first arrows, and we can always orchestrate a situation where, oh my God, what did Terry do? I never told him to do that. And so you get a second, way forward, I guess, after that failed first negotiation, perhaps. And Lou, I'm telling you my secrets, I guess.
I've lost enough deals to Terry, so I know all his game plan. I lose to Terry most.
So Terry, is that why you were living in Cleveland for so long? Is that you were absorbing all those arrows? Is that?
Well, I guess as of a day ago, there are no more Cleveland Indians. So
no, they're the Guardians. They're the Guardians. They're the Guardians of the lake that's on fire.
Yeah.
Or I guess it's a river that's on fire. Sorry for those of us that are old enough to remember it. So I have one other thing, and we've got 3 minutes left. So, without disclosing any names, if any one of you wants to step up, give me an example of why a deal had gone sideways and why. I want to lie. I want not necessarily live that you're working on now, but give me something that's real.
Well, I'll go first.
Lift up your own kimono.
Yeah, I will say the most frequent reason our deals on the M&A sell side go sideways is earnings problems within our client. And honestly, doing an M&A deal or doing a recap, doing anything in, kind of in the deal business is exciting. And I just get the sense sometimes the client takes their eye off the ball and gets wound up in the deal. And the number one thing the client has to do is run the business like it's always been run. And so that would be my thing, and I'll turn it over to the other guys.
I think the stuff we've run into, it's something that they didn't know before we started the process. An issue came up, whether it be regulatory or financial, or with a client, or with wage and hour law under the U.S. Department of Labor, whether they really didn't know that they were violating something wrong because they hadn't had regular checkups by their advisors over the time. They hadn't had a close relationship with an outside attorney that was looking at their stuff. They haven't had an advisor look at all their tax situation. And then when you're going down this deal and they didn't maybe review their kind of current status with their state tax position, and then they're surprised that there are audits that will probably get triggered in 7 states that they do business in, and they want the buyer to take all that problem. That's just, those are the things that happen when, they haven't done enough to get ready for the process, because there's always stuff that they don't know. It's what you don't know that'll hurt you. It's not what you do know. It's what you don't know.
Mike?
Yeah, similarly, I throw the biggest problems under the bucket of lack of communication. Or lack of clarity in communication. I think before the deal, when you're still negotiating, if you're being sort of very open about here are the issues and here are why we think they're not issues, that engenders a lot of trust and helps get the deal done. After you close the deal, when you're partners, the worst thing you can do is shut somebody out if you're going to run processes without including people, they're going to feel excluded and they're going to think you're trying to trap them. So they're going to look for opportunities to gain back a little bit of control. But if you're talking to them regularly, you're including them in the conversations, especially if they've got, a board seat or they're part of the management team, having those open lines of communications is going to head off a lot of your problems. When there will be disagreements, of course, but if you're open about talking through those disagreements, you can at least try to head off people's feelings getting hurt.
And now we're at our 40 minutes. When I talk to a business owner, I kind of refer to it as you run the business, hire professionals to run the process. Because the worst thing that can happen is you lose your eye on what's going on in the business, as Terry said, where his goes sideways. What I'd like to do, I'd like to thank everybody on the panel for spending time sharing the smart business. We're going to be live after this. You can have question and answer with us. Please join us. We appreciate you spending time listening to us, guys. Thank you very much.
Thank you.
Thanks.